In this video, I'll share my investing journey and biggest investing mistakes. My name is Kayla, and on this channel, I document my experiences with money, self-growth, and life on my journey to financial freedom. I am not yet financially free, but it is my goal to find my own path there eventually. This video is part of a mini-series about the past 6 years of my journey to financial freedom, where I talk about my experiences with things like managing my finances, investing, and building additional income streams. I share my journey from the beginning to present, including the steps that I've taken, the mistakes that I've made, and the lessons that I've learned along the way. If you have not caught the first video in this mini-series, I have linked it down in the description box below. It will give you some context on what my finances looked like before I started investing, which is the topic of this second video. I will share how I learned about the different aspects of investing as I started out as an investor seeking to protect my savings from inflation to an investor seeking to grow my wealth. I will also share my biggest investing mistakes and how they turned me into the investor that I am today. If you are working towards financial goals of your own, I hope that my videos will provide you with some insights and help you to avoid the mistakes that I have made. But, like I emphasized in the previous video, personal finance is personal. The financial decisions and choices that I share about in the videos were based on my unique circumstances, my risk tolerance, and my own judgment of the information I was aware of at the time. I am not a financial expert, just someone on the internet who is figuring out her way to financial freedom. So, with that out of the way, let's get into the video. I had an inkling of how much money I would need to be financially free, and I knew that saving alone, at least on the income from my day job, would take me a really long time, especially when the money in my bank account would only devalue every year as inflation eats away at it. So, how do I protect my money from losing value? This question led me to start dipping my toes into investing. About 5 years ago in 2018, in my search for ways to protect my savings from inflation, I was presented with instruments such as high-interest savings accounts. Back then, my money was held in a POSB savings account that was set up by my parents when I was a kid. And that account had one of the lowest interest rates in comparison to the ones that came up in my search. DBS had a high-interest savings account called the multiplier account that was comparable to what the market was offering back then. So I applied for it and moved my money over. The bulk of this money was my emergency fund, which I talked about in my first video. Such high-interest savings accounts usually have conditions to be met to qualify for the higher interest, such as salary credit, credit card spend, and investments. The more conditions you meet, the higher the interest tier. Seeing the interest rolling in was exhilarating for me. Interest was credited monthly, and I was gaining interest on the interest in the next month. Although the amount wasn't huge, it was already so much better than the interest that I was previously getting. I also came across bonds in my search to protect my money from inflation. Bonds are issued by governments and corporations to raise money. When you buy a bond, you give the issuer a loan. They in turn pay you back the face value of the loan at a future date and pay you interest periodically along the way. Because investments was one of the categories that would qualify me for a higher tier of interest in my DBS multiplier account back then, I put a portion of my savings into the Singapore Savings Bonds, or SSB, which are backed by the Singapore government. The SSB pays out interest to bondholders twice a year. I needed monthly returns from my investments to qualify for the higher interest tier every month. So I built a bond ladder by buying a bond every month for 6 consecutive months. The twice yearly interest payments that I got from each bond gave me a tiny monthly income stream. I was doing this in 2018, so this strategy may not be applicable anymore as the conditions to qualify for higher interest with the DBS multiplier account have changed over the years. I am also no longer using the multiplier account and have switched to other banks over the years. Around the same time that I was very focused on generating high interest for my savings, I came across the concepts of dividend investing and investing for capital appreciation. I realized that investing could help me to grow my wealth beyond simply keeping up with inflation. I became interested in learning how to generate larger returns than the interest payments I was getting from my savings account and bonds. I didn't know exactly what I was looking for, but I tried almost everything I read about that made sense to me and that I was comfortable with. I came across financial instruments called exchange-traded funds, or ETFs. ETFs are a type of pooled investment security that holds multiple underlying assets rather than only one. Because of this, ETFs provide diversification in a portfolio. The ETFs that caught my eye were focused primarily on the Singapore market. These included the Straits Times Index STI ETF, Real Estate Investment Trust REIT ETFs, and the ABF Singapore Bond ETF. I studied everything that I could find about their composition, portfolio management, risks, fees, etc. ETFs are riskier than the SSB because the principal invested is not guaranteed. But I understood the products and was comfortable enough to passively dollar cost average or invest a fixed amount of money into them every month, regardless of the price that they were trading at. The ETFs paid out dividends. Receiving dividends from these funds was similar to receiving interest payments from the SSB. But this was my first experience watching their prices fluctuate around and seeing unrealized capital gains and losses in my account. About a year later, I came across an investing approach by the Bogerheids that resonated with me. It utilizes a 3-fund portfolio that aims to diversify a portfolio across 3 asset classes, comprising a total US stock market fund, an international ex-US stock market fund, and a total US bond market fund. This was created with US investors in mind. Since I am based in Singapore, I took the principles and applied them to my own context. By this point, I wasn't unfamiliar with passive investing in ETFs. What was new to me was investing in international markets. During my research process, I realized that different local investors adapted it differently, particularly given the size of Singapore's market relative to the international market. After much analysis and deliberation, my adaptation of the 3-fund portfolio that I was comfortable with looked something like this. I held Singapore bonds, which included the SSB and ABF Singapore Bond ETF. I also held Singapore stock market funds, including the STI ETF and REIT ETFs. And lastly, I held international stock market funds, including this Vanguard All World ETF and this iShares World Small Cap ETF. If you are interested to learn more about the Bogerheids 3-fund portfolio, check out this book by Taylor Larimore. For about 3 years, I was a passive investor, dollar cost averaging into ETFs. It was at this point that I started paying attention to the opposite of passive investing, which is active investing. These 2 approaches are often contrasted and debated. The type of active investing that stood out for me was value investing. I was drawn to Warren Buffett's value investing philosophy. There's an article on Investopedia that summed up his approach pretty well. Some of his investing principles include waiting for the stock of a company you want to invest in to reach a reasonable valuation before investing, staying invested even in down markets, and deeply understanding the business behind the stock that you are buying. If you are interested to learn more about Warren Buffett's approach, you can check out these books that have helped me to grasp the nuances of his approach. The more I read, the more excited I was about this approach. So much so that I decided to be an active investor and sold off my investments in bonds and ETFs. This was in 2021, and I have to say that a large part of this decision to sell everything off was influenced by the market, which was approaching all-time highs in a low interest rate environment. All the investments that I sold off resulted in a profit. But this was also where I started making my biggest mistake yet as an investor. I was sucked into the market frenzy and lost all sense of judgment when I saw the stock prices going up. With my assets now in cash, the temptation to jump in was too much for me and I gave in. I bought stocks of solid big-name companies, but at exorbitant pricing. I also bought into the hype of non-profitable growth stocks and cryptocurrency. I was definitely not acting on sound investing principles. I was acting on a fear of missing out. When the 2022 crash came, my portfolio went down with it, and this was my first time seeing so much red, with an overall paper loss at one point around -50 to -60%. It was an awakening and a very painful lesson. I didn't sell any of my positions. Instead, I took a step back from the market, focused on learning about value investing, and re-evaluated the kind of portfolio that I want to build. 2022 presented several opportunities to pick up stocks of great companies at undervalued prices. Unfortunately, most of my money was already in stocks that I overpaid for, and I could only channel funds from my monthly paychecks to invest in those opportunities. Here, I made another big mistake by dipping into my emergency fund for cash to invest in those opportunities. I should never have done this, because this was clearly not an emergency, and it would have been devastating if an emergency did come up. To date, at the end of October 2023, my portfolio has recovered most of the paper loss due to the recovery of the stock market and also because of the undervalued stocks that I picked up in 2022. However, a small handful of non-profitable growth companies and crypto that I invested in have not yet recovered. But I gladly take this as the price of a very important lesson learned. Stepping into the world of investing has been an empowering journey as I realized that my money could work for me in return. It has been about 5 years since I started investing. I had a blast learning about the different types of investing approaches and received a painful and hard lesson in investing safely. The knowledge that I gained along the way has changed the way that I invest, and I am still learning to be a better investor every day. Learning what I had, understanding how much volatility I can tolerate, and taking into consideration my life circumstances, this is how I am protecting my savings and growing my wealth as of recording this video. I have a high-interest savings account for my monthly living expenses and another high-interest savings account for my emergency fund and near-term expenses that I am planning for. This is separated to keep myself from dipping into this for non-emergency situations. As for investments to grow my wealth, I plan to allocate 70% of my investment portfolio into US and world ETFs using a passive dollar cost averaging approach, and the remaining 30% into individual stocks using a value investing approach. On this journey to financial freedom, the fundamental question that I've always had at the back of my mind was, how much do I need to be financially free? Over the years, I found some answers for myself, but always subconsciously left it there, and never fully addressed how I would go about doing it. I'm not sure why. Last year, this question surfaced again, and demanded a proper answer. Maybe it was a combination of, there's nothing more to do other than funneling my savings towards investments every month, and of growing older. Entering the final year of my 20s, time was no longer a luxury as it was in my early and mid-20s. In the next video, I'll share how I address this fundamental question for someone on a financial freedom journey. Thanks for watching until the end. If you enjoyed this video, subscribe and check out other videos on my channel. I'll see you in the next video. Bye!